Investors Chronicle.
Welcome to the Companies and Markets Show, our weekly discussion of all the big goings-on in the world of UK-listed companies. We are recording today on Thursday, the 12th of September. There's been a pretty big increase in volatility in the market this summer, but as ever, there are still stocks that are powering ahead. And we start today with one of those. That's reviews platform Trustpilot, which reported figures on Wednesday. Jennifer Johnson and Alex Newman will debate whether its success can continue. Our cover story this week is a big one, our annual top 50 funds list. Funds editor Dave Baxter, finally at liberty after spending weeks chained to his desk to compile said list, is here to talk us through it. And finally, we will talk about engineer Reinshaw, which reported full-year figures this morning. Mark Robinson and Julian Hofmann ask if there's signs of life for both the precision equipment manufacturer and the semiconductor industry into which its products feed. Let's talk about reviews. In the online age, everyone's a critic, and that plays into the hands of a business like Trustpilot, which charges clients for collecting and analysing customer feedback. It reported half-year figures the other day, as we said. Jen, it's fair to say those figures look pretty good.
Yeah, they certainly look to be kind of the best we've seen, really. I guess one of the major positives is that the group has made a pre-tax profit for the first time, albeit a fairly modest one of about $2.5 million US. Management also said that full-year EBITDA will come in at the upper end of expectations, which pleased investors. And the company's initiated another share buyback. So all of these factors put together kind of explain why the shares are up 10% in the past 5 days. Of course, and I'm sure we'll get onto this, there are some lingering questions about the long-term viability of the company's business model, given the fact that there are kind of plenty of online town squares, if you like, where companies can go and look at the feedback that their customers are providing. In that sense, Trustpilot is playing in a rather crowded marketplace.
Yeah, I think we're all familiar with various sites like this. Trustpilot clearly is a big one, but you've also got the likes of Amazon and Google, of course, whatever you review. We'll come on to that, as you say, but let's talk about Trustpilot in particular for a little bit longer. There's a newish chief exec. He's been there about a year or so now, I think, and one thing he's been trying to do is get more and get bigger enterprise, i.e. business customers on board, because that's really where the money is made, clearly. What have they been doing to attract this group, and where have they been trying to attract them as well?
I guess it's useful to kind of summarize the business model. So Trustpilot has what it calls a tiered software as a service model. So for a set monthly fee, companies can send out things like automatic invites asking customers to review them on the website. And it also offers an increasingly detailed set of analytics so that companies can get insights into what consumers are saying about them. These analytics are naturally AI enabled. So in that case, the AI is essentially reading and summarizing reviews for you. And I think it has a feature now where AI can even respond to reviews on behalf of the company. And that's a paid feature. So obviously, the more you pay, the more that Trustpilot provides you with, the more kind of insight and communicative capabilities you're offered.
One of the areas it's been focusing as well is the US in particular, and that was a particular highlight in these figures.
Yes, it was. So North America revenue was up by 16%, but the UK kind of remains its most important regional market. And I think there's also some indication that spend on Trustpilot is correlated with marketing spend more generally. So obviously companies tend to tighten their belts when the economy slows down. So there's reason to keep an eye on Trustpilot's progress in the US, depending on how things kind of fare on a macro level as well.
Yeah, there is that question of whether we should treat it as a marketing and therefore a cyclical business as opposed to a tech software as a service.
Yeah.
Essential business that will thrive throughout all conditions and come what may. That probably brings us on to the business model in general, because there is a network effect involved here, clearly, insofar as if you're a business and you see other businesses on there and it becomes a recognized thing, there's the kite mark you can have on your website. Say we have a score of 4.9 out of 5 on Trustpilot or whatever it may be. the more people who use the platform, both to review it, but also the more businesses that are on there, the more others will feel encouraged to do the same, certainly on the business side of things. But there is that question about, if this nonetheless is marketing spend, how resilient is it going to be in an economic downturn, things like that. Of course, you could say that about many businesses. Alex, maybe I'll bring you in here because I think you have some thoughts about the way that mission statement perhaps corresponds or otherwise with the day-to-day goings on at the business.
Yeah, so I suppose to return to the software as a service, is it software as a service? Is it a clever marketing tool question? I think this can be a sticky part of companies' marketing spend, definitely. But the question about how scalable this software is and what it has to offer companies versus what they might be able to replicate in-house or is industry standard or is really hard to switch out of, which I think are the true hallmarks of really, really sticky software as a service, scalable platform businesses, I think is in question. So I think they're basically staking a claim to their own relevance in the internet ecosystem. So I think to offer a genuinely indispensable product, that seems to be the thing that is reflected in its sky-high valuation. But if you look at, for example, the high street retail banks, they just haven't engaged with this, and that's a really important consumer service that. If you were shopping around for a bank, I mean, lots of people stay with their banks forever and don't move around. But if you were shopping for one, you wouldn't really get a clear comparison. I don't think if you look on the profile pages they host for the High Street 5, compared with the sort of digital first banks, which have obviously invested very heavily in the engagement via Trustpilot because it is one of their, as a digital first business, that's one of your sort of go-to marketing spend. So I think to really be able to claim this moniker as providing a currency of trust on the internet, laudable aim, definitely, and something we should all hope they are able to succeed in the long term. I think you have to have a lot more buy-in, all kinds of businesses on the internet. So yeah, I think that really remains to be seen. And at the moment, it's I think Peel Hunt, one of the analysts there, say that there's a bit of value here because it trades on a forward enterprise value to sales multiple of 4 times, and that's a discount to the peer group average. But I was looking back at the initiation note, and the same analysts point out that there's no real direct peer comparison here, and I don't think they sit squarely in the software as a service category. They are somewhere in between normal marketing services and software. So yeah, like Jen said, I really agree. You've got to really approach this with caution, I think, from a long-term perspective, though obviously there is momentum here in the stock.
The question of what businesses use this for is interesting as well, isn't it? If we think about our own behaviours, or certainly my own online behaviour, I would use a site like this when it's a company with which I'm not familiar.
Yeah, definitely.
To check as per the new bank. Certainly if it's a new bank, you want to make sure it's up to scratch. But if you're considering or using, NatWest, Barclays, something like that, you don't need, in some ways, the reassurance of a Trustpilot. You know what you're going to get. You might not like the interest rates they offer, for example, but you know what the company is about. You don't really need to read a review of a bank service, a big bank service in the UK. Therefore, the question then becomes, what are the companies using it for if they're an established brand? And clearly what Trustpilot is trying to push is the idea of this analytical service of being able to look at all the feedback you get from all your customers. And I think we can all agree that whenever you buy anything online, you're bombarded with messages about leaving feedback for the product afterwards, and to be able to filter that and take some intelligent stuff from that. But there's also maybe the question of they're using AI to help make sense of this, but companies could just use AI themselves, perhaps.
Question really is, if you're a company, couldn't you just kind of go into your Google reviews once a month, paste them into a Word doc, and then ask ChatGPT to summarize the sentiments there? Obviously, Trustpilot kind of offers those AI responses as well. Engagement on Trustpilot is not even a reflection necessarily of a company's genuine willingness to kind of engage with customers and resolve their issues. As long as you've claimed a profile on the site, you can respond to the reviews that are left there for you. But it's one of those things where, the companies that you see really engaging, that seem to be very active in trying to resolve customer issues on the platform, they're probably also paying for the service. And the kind of companies that are on there, as Alex said, it's not your Lloyds or NatWest. It seems really it's mid-size, e-commerce companies that are kind of among the most reviewed and the most responsive businesses on there. So if you're an Amazon.com, which has something like a 1-star rating and over 30,000 reviews, you don't need to engage because customers are going to use your service regardless of whether it's well reviewed. But these kind of smaller, more niche retailers, that's not necessarily the case.
I don't really know how to read my own personal response to anything AI related at the moment because it's so buzzy. But my instinct is to get, if I was to be a Trustpilot, if I was a Trustpilot shareholder, it would be to be a little bit nervous about that because it's not quite clear yet that this operational gearing effect is really kicking in. So their operating profit in these accounts in the half years went from a loss of $2.1 million last year to 1.8 million. And that was off the back of a $15 million bump in sales. So we could look at that as a nice kind of 27%-ish operating profit margin on new business that might get progressively higher. But it's not quite clear yet that they are sort of escaping from the increase in expenses that comes with having to sell all these packages to new clients, which is, they're high upfront acquisition costs, and we don't really know the long-term benefit of some of those contracts. So bringing in AI would be a sensible thing for a new CEO to do because it's about reducing cost. But do you then dilute the product? Then if I wanted engagement with a customer, I wouldn't want to just defer that to a tool that's just been invented in the last year. Yeah, so I don't know. I think it's a bit of there's an ugly trade-off that seems to be being made there.
All this said, we've outlined a lot of the bare points, but there's no doubt that there are a lot of companies who will still rely or increasingly come to rely on this kind of service, new companies or companies trying to make a foothold, and there's always going to be companies like that. And it's certainly making inroads with them based on what we've seen in North America, the growth there in particular. That growth strategy does seem to be working. And partly for that reason, Jen, we do have them on a buy.
We haven't reached this point of saturation with Trustpilot yet. Trustpilot is still kind of making inroads in these new larger markets. So I think there's reason to be optimistic about it in the short term, for sure. I mean, upgraded guidance, that kind of thing. Obviously, expectations are also very high at the moment, but I think there's no reason to think in the next couple of quarters that it's not going to kind of hit those expectations. What you need to be looking at really is in a few years when all the businesses, or the vast majority of the businesses that are going to engage with Trustpilot as a platform are already there. When these bookings, that's kind of what they, the terminology that they use to describe customers, when those start to flatline a little bit, I think that's when you need to really be questioning Trustpilot as we have been today.
It's kind of the tyranny of high expectations ultimately when the growth rates become so difficult to keep up. But nonetheless, that is a good position to be in while you are still increasing growth rates. So the company is clearly doing a lot of things right at the moment. We're going to turn now, though, to our cover story this week, which, as I said at the top, is the annual top 50 funds list. Dave, as mentioned, you have been working on this list for some time. It's publishing today on Friday, the day this podcast comes out. Why don't we talk a little bit about the rationale behind the list, first of all? In some ways, it's quite self-explanatory, but there's clearly thousands of funds out there. So to boil it down to 50 requires some thinking about what kinds of funds we're looking for and also, of course, ultimately how you judge a fund to be worthy of inclusion.
So I guess the word best is incredibly subjective, but what we try and do is, I suppose, again, this year we've seen the kind of dominance of a handful of stocks and dominance of the US and so on. So it feels increasingly perhaps intuitive that people might want to simply buy a tracker or mainly use a tracker, but active funds still do play a kind of useful role in portfolios. So what we try and do is look at funds that will basically tend to offer something different. So they might have a process that works really well. They might have higher kind of concentration portfolios focused on just a handful of stocks, or they might, for example, say looking at a global fund, they might not be relying on the likes of, say, the Mag 7 in the way that a tracker would. And then there are just a handful of kind of other criteria you can look at, whether it's kind of investment process, the staff, the track record, how much risk they take, and so on. And also, it's just worth noting that we kind of combine the quantitative and the qualitative here. So we do always bear in mind kind of performance over the last year and over the longer term and so on. But we kind of consult with a panel of multiple kind of specialists from the industry who will give their takes on how they think funds will kind of fit into a portfolio and why they stand out.
Yeah, despite my description, it's a fair point that it's not just you locked in a room on your own. We do have that panel there to help with the list. And what about in terms of the asset classes? How is it structured in terms of the balance between equity, bond, alternative, etc.?
I do like the idea we're just all locked in a room. It's good. But in terms of kind of asset classes, we, a bit like I suppose our top 50 ETFs list, we focus still mainly on kind of equities, given that they will generate a lot of portfolio growth. So 35, I believe, of the 50 funds are kind of equity vehicles. And then we structure it. We kind of largely look at growth equity across kind of the main regions. So, the US, the UK, Asia, Japan, and so on. Then we look at income options, sort of in the UK, but also, again, global and some interesting regional picks. And then beyond that, we look at some other kind of asset classes. So you have bond funds, you have the so-called wealth preservation funds that should try and protect you from kind of market sell-offs. And then we have some other alternative asset classes like infrastructure and private equity and so on.
We won't go into the specific changes this year, or at least all of them. We'll let people have a look themselves for that. But there have been fewer this year than the last couple. Can you talk about sort of the thinking behind changes in general, why there was quite a bit of turnover a couple of years ago, and what tends to prompt a change? Because obviously, as you say, we're aware of performance, but equally we are mindful that we don't want to chuck something out on the basis of a bad year or vice versa.
Yeah, it's interesting because in theory, these lists should be quite static. As you mentioned, this year we've just made 5 changes versus 12 in 2023 and 11 the year before. But you should kind of let different funds, leave them in place to kind of complement each other and so on. Just going back to those kind of earlier years of higher turnover, that was partly, I suppose, a response to just the sheer level of kind of market volatility we saw, particularly in 2022. That kind of moved some valuations around on some funds. That also exposed some kind of weaknesses. And it also kind of, I suppose, made us more aware of the need to really diversify by things like investment style in some of the categories. So this time round, the list is still pretty well diversified. So you do have different options depending on how you want to kind of play a market, or if you want to hold, say, a value and a growth fund alongside one another. And just looking at some of the changes we have made, a lot of those have actually this year been related to kind of personnel changes. So just to mention one, the well-known kind of value manager, Ben Whitmore, is moving from Jupiter to another company. So we've kind of parked his fund, outside of the list and put something else in its place for now. But yeah, there's been quite a lot of kind of personnel changes. So we've just put in some kind of safer options for the time being, and then we'll keep an eye on those funds that were in the list to see, whether the process is still holding up.
Yes, it's fair to say, isn't it, that while bad performance, as I said, doesn't automatically mean a fund should leave the list. When you get periods of volatility, you do learn in some ways a lot more than you do when things are going well about how funds perform, whether they're at least performing as they say they will or as they should be doing, even if that's not particularly great performance. So yes, there's no doubt that increased volatility can lead to a bit of a rethink sometimes. What about funds versus investment trusts? Because we use, for this purpose, for the name of the list, funds as a catch-all term, incorporating both open-ended funds and investment trusts. What's kind of the proportion between the two in the list, and how do you decide on occasion one versus another? Because there are some occasions where an investment trust has an open-ended fund equivalent and so on.
Yeah, it's pretty trust heavy, the list. So had a quick sort of count, and it's, I think roughly 30 of the funds are trusts. And that, I suppose, kind of partly reflects the kind of valuation opportunity we've seen in the trust space in the last couple of years, big sell-off across the space and some interesting kind of price tags going on. Also, I suppose with anything in the alternative space, we're going to tend to focus on trusts just because, that's the kind of vehicle that is suitable for something that's not liquid like private equity. But yeah, as you mentioned, you do get cases where The same team will run kind of a trust and then an open-ended vehicle. Where that's been the case, we have actually often tended to back the kind of open-ended fund, but mention the trust, and that's simply because the open-ended fund will be a bit simpler. So we're kind of giving the more basic option where you don't have to think about things like, investment teams borrowing money to deploy more investment or discounts or kind of board management and so on. But then we do also kind of highlight the trust option if you are feeling perhaps more kind of, if you're more comfortable with those kind of ins and outs and you want to accept, in theory, trust should have more volatility, more complication, but hopefully in the long run should have better returns.
Alex, I think you had a point on this subject.
Which Dave just pretty much answered. But I mean, I did actually have another question, though it may jump the conversation on to another point. But it does also relate to this distinction between open-ended, I suppose, and investment trust structures. David, I was just looking through the performance of the two wealth preservation funds you have in there, Ruffer and RIT. I thought it was interesting what you're saying about, you look at both qualitative and quantitative metrics when sort of weighing up the top 50. I wonder if, that, I'm just interested in your take on that category as one that almost defies categorization, because they're from the off, they've got this kind of get out clause of differentiation that they're not tracking an index, and yet it's all comes down to this sort of the qualitative, slightly subjective definition of what they're actually doing. I'm just interested in seeing what the you thought of that, or the judges' view on keeping wealth preservation funds in there.
Yeah, I think it's kind of that relates to maybe a broader issue with kind of active investing, because as we've been discussing now for years, you've had kind of often a few stocks driving returns, and it's been very hard for anyone who doesn't want to simply kind of ride that wave to do well. They're either going to lag or they're going to not perform well at all. It's tricky because I guess you always think that diversification should play out in the end or when you need it. And I suppose in 2022, we saw, I think Ruffer did pretty well, but a lot of it is, kind of hope or the suspicion that things will change. And obviously for many years, we've been discussing, the US equity market going gangbusters and often being driven by a handful of stocks. So it's almost like the kind of insurance point where you don't really want to have to use it, but you do need to have it beforehand.
As we say, this is the cover story this week. It is online as well by the time you listen to this podcast. So do have a look through there and have a filter through all the different categories, and hopefully there'll be something of interest to most listeners in there. We're going to conclude today, though, with Reinshaw, which put out full year figures this morning. This is a company which, as I said at the top, has been feeding into the semiconductor industry and therefore has had quite a rough time of it over the past couple of years, because despite all the talk about the Magnificent Seven and AI and chips and NVIDIA and things like that, a lot of other semiconductor sectors have really struggled for quite some time now when you consider they feed into the automotive industry and personal computers, smartphones, things like that, where demand has been weakening a bit. Mark, what was your take on the results? There were figures, I think profit figures at the bottom end of guidance, but maybe a lot of the bad news by this point is in the price.
Yeah, I'd imagine so as well. I think the share price itself is down by about 6% over the last 12 months, but I think it's a long-term narrative here. I think they've been drifting over the last 3 years, really, and there are a number of reasons for that. You allude to the fact that the semiconductor market is softening, but there are also concerns over management practice, and we've seen some shareholder opposition over that period as well. In terms of the bare bones of the announcement, revenues were flat on a reported basis, but up by nearly 4% at constant currencies. There were record revenues as well, but we've seen no shortage of that in the post-inflationary world too. A 13% drop in adjusted profits. Margins have come under pressure, not least because of the ongoing capex bill of the company. The largest segment, manufacturing technologies, revenue there was flat, and it meant that fed into a fall in adjusted earnings from 155p last year through to 133 this time around. Management held the dividend flat at 59.4 pence as well. So the main trouble, or the immediate problem linked to margins here, is that, as you say, demand for the semiconductors, they slumped, or at least softened rather, at a time when the company was committing substantial sums to expansion and sort of on an industry-wide basis as well. I think like surface inventory was a problem that takes a while to work through too. So, I think we'd be right to link the recovery, or the projected recovery, to that capex spend. And it's, as I say, it's having a negative effect on operating margins, but at least Reinshaw seems to be approaching the end of the cycle in terms of capex, which is a positive for investors.
Yeah, it did make some comments this morning, management did, didn't they, about seeing cash flows improve from next year as that capex spend starts to fall away. That spend has been on, I think it was set in motion really before the semiconductor pandemic-induced issues all began, really, but they spent quite a while sort of expanding operations, but that's almost done now. Julian, I want to bring you in because there are some green shoots here as well, potentially, in the figures in terms of that cycle turning, perhaps.
Yes, there are actually, Dan. Reinshaw is a really interesting company because it's only really, you can almost ignore the results on the top line and have a look at what the inventory and underlying spending is doing, because that usually tells you where sort of orders are coming through, or where the company sees that it doesn't have to keep so much product on hand, or orders are sort of picking up again. And the figure that caught my eye was that their inventory is starting to fall. And when you look back over the years, that's always happened about 6 months out from where there is a full recovery in profitability, because over that 60 to 180 day cycle, that's when new orders come in and they get paid. So there's an almost predictable lead time to it. So in these results, the inventory fell by 13%, which is quite notable. It's a sign, one, that order uptake is coming in, but also that post-pandemic phase where everybody felt they had to keep a lot of products on hand because they were having trouble with the supply chains, there might be a suggestion that is now starting to ease. So that was quite positive, I thought, from Reinshaw from that point of view. And as Mark mentioned as well, they have been spending a lot on capex, and that's fallen again in these results because they completed the first phase of a project in Wales to double the factory size. And they bought a couple of sites in the UAE and in Brazil. So it's a lead indicator. I think you can never dismiss this type of company as having a bad year, because somewhere in the weeds there will be signs that things are getting a bit better for them. And it's also worked through the system that investors now seem to have accepted that they're not going to get bought out by Siemens, which was the big speculation earlier in the year, which actually ran up the share price, in my view, to an artificially high level. So they're back down to about 25 times earnings, and that's really not far off their long-term average. I think it's looking better for them, and investors will probably start getting interested again on its own merits rather than expecting sort of outside forces to do all the work.
Yeah, the discussion of the sale brings to mind, of course, when I think it's 3 years ago now, they effectively tried to put the company up for sale. It didn't pan out. But part of the reason they did that is because, as you alluded to earlier, Mark, there has been some opposition to the structure of the management team, because the company's, I think, 51 years old now. Its co-founders, David McMurtry and John Deere, are both mid-80s. So there are questions over their roles. They are no longer in day-to-day charge. There is a separate chief executive, Will Lee. But the percentage of shareholders are voting against them at the AGM, voting against their re-election, does seem to rise a bit each year. So there is that Outstanding question, McMurtry is executive chair, of what comes next for the company.
It wouldn't have happened at Berkshire Hathaway anyway. I think the octogenarians there are relatively safe, or at least one of them is. I think it would make an interesting case study, Reinshaw, and just the pros and cons of having co-founders in the hot seat for that longer time. I think a lot of investors became frustrated primarily because of that lack of succession planning and the fact that they refused to sign a relationship agreement which was aimed at limiting their power to outvote other shareholders, because I think between them they have a majority holding in the company. I might be wrong on that one, but I think they've got a majority holding there. So yeah, I mean that's sort of put a little bit of a lid on the share price over the last couple of years as well. Looking at the valuation case, it's Michael's working on this this morning, so I don't want to. Michael Fay's working on this morning, so I don't want to say anything that's contradictory. But I was looking at the forward rating at 20 times. It's not excessive at the moment, and that we should see some improved return on equity over the coming years as well. You probably get a better, given the company has quite a large cash buffer. So I think the enterprise cash profit rating at 13 times is a better guide to that. And on that basis, it looks like fairly good value compared to peers, although it's difficult hunting down a peer group for it, and from a historical basis. But until I think that CapEx process reaches its logical conclusion, it'll be difficult to make an informed decision there. The longer term investment case is underpinned by the increased demand for integrated circuits in AI, other digital technologies, and even electric vehicles, or that seems to have gone slightly awry of late. So yeah, I mean, it's looking positive from that point of view, but it is a work in progress. I think when it comes to the half-year mark, we might have a better idea of what the increase in capacity and improved distribution channels will have on the group.
Yeah, that return on capital was always, historically was always very strong at Reinshaw. It has dipped in the last few years given that CapEx, but potentially that shift is coming. In some ways, it does remind me a little of Rolls-Royce in that we wait all this time for the cash flow to come through. When it finally does, it would be bold for me to say that the share price is going to take off in the same way, but when it finally does come, you can really see the benefits there. But we'll see if that happens.
Presumably their accounting treatment's a little bit more in line with accepted standards than Rolls-Royce were. But
yeah, certainly back in the day. Yeah, I was more thinking perhaps about Mike's buy call on both companies, based I think on that cash flow coming through. The other thing I should say actually is you're right. They do McMurtry and Deere. They do have 52% of the shares. I think that last look. So clearly that is a potential overhang as and when something changes there as well. We have, though, come to the end of today's show. We have run out of time. So thank you very much to you, Mark. Thank you to Julian, to Alex, to Dave, and to Jen, and to our producer, Maddie Apthorpe. And thank you to you for listening. We'll be back next week with another Companies and Markets show.